Welcome to Smart Crypto, the channel where you will learn how to make money in the crypto market. Hi, my name is Luke, and in this video we will dive deeper into the mitigation concept. We will show where exactly you can find it on a chart and how to use it for trading. In the previous video we explained how liquidity is a driving factor behind the market behavior of smart money. Another driving factor behind smart money behavior is called mitigation. Mitigation is defined as the reduction of something harmful, or the reduction of its harmful effects. Remember that we explained that smart money sometimes must act as a market maker. In this capacity, it must take on positions at prices that no other market participants are willing to trade at. On other occasions, smart money acts as a market manipulator and drives prices to levels opposite to their true intentions, often hunting liquidity pools. On both occasions, they take on long or short positions in their order books, which they intend to eliminate as soon as possible. To reduce the harmful effects of these positions, market prices are manipulated to levels where smart money can eliminate these positions and then drive back prices to levels in correspondence with the current market trend. This process is commonly called mitigation. In this session, we will identify two types of mitigation. The first type we call imbalances. The meaning of imbalance is lack of balance, the state of being out of equilibrium or out of proportion. In trading environments, imbalances are also called market inefficiencies or one-sided price action. Imbalances occur when price moves quickly and sharply from one level to another. According to the efficient market theorem, buyers and sellers must be able to enter the market at every price level. When prices move fast, it can happen that only buyers or sellers did get an opportunity to enter the market with one-sided market orders. In that case, smart money must act as a market maker and must fill the market inefficiency with matching orders. Sooner or later, smart money will bring back prices to these levels to mitigate the positions they were forced into. In the next example, on a 4-hour chart of Bitcoin dollar, you can see different examples of one-sided price action. See all the red boxes. The black arrows indicate how all these imbalance zones are mitigated with future price action. The green arrow indicates an imbalance zone yet to be mitigated. A specific case of an extreme imbalance is a price gap. A price gap is an area on the chart where no trading activity at all has taken place. A gap up means that the low of the current candle is higher than the high of the previous candle. A gap down means that the high of the current candle is lower than the low of the previous candle. Different types of gaps can be distinguished, like breakaway gaps, highlighting the start of a new directional move after a price consolidation, a runaway gap in the middle of a trend, or an exhaustion gap at the end of a trend, suggesting a possible reversal. Gaps must be filled. Exhaustion gaps tend to be filled sooner than breakaway or runaway gaps. Gaps typically occur when a piece of news or an event causes a flood of buyers or sellers into the asset. It results in the price opening significantly higher or lower than the previous period closing price. In the following example, you can see two types of gaps: an exhaustion gap, which is filled quickly, and a runaway gap, which is filled much later. The second type of mitigation I like to call the buy to sell or sell to buy pattern. Some also call them order blocks. Whatever you want to call them, most important is that you understand what it is and how it's working. A buy to sell or sell to buy pattern is created when smart money is manipulating the price in the opposite direction of its true intentions. By taking a long position in their order books, they tease the less informed traders into taking long positions with them. When the desired price level is reached, often at the level of liquidity pools, they start selling aggressively at these higher prices, causing the prices to fall steeply. During the steep bearish trend, they close their short positions by buying back at lower prices, realizing huge benefits. However, they still have the long positions from the initiation of the manipulation open in their order books. In the future, prices will be driven back to these levels to mitigate these long orders in break-even or with small profits. Let's have a look at the following example. What you see here is a euro-dollar weekly chart. Because of the fractal nature of markets, the same patterns can be found on all time frames. On this chart you can clearly see at what levels all order blocks are initiated and how they are mitigated. We will focus on the first order block, which is initiated in 2014 and gets mitigated in 2018. Let's dive a bit deeper into the origin of the first buy to sell pattern. In a bearish market, price action takes out sell side liquidity and next moves higher to attack the buy side liquidity. Then very strong bearish price action continues to take the prices to lower levels. Our future level of interest is indicating the buy to sell pattern. As you can see, the mitigation only happens in 2018. All this time, smart money kept these positions open with heavy losses, something you can only do if you have very deep pockets. Now, let's look into detail at what happens at the mitigation level. First of all, are we sure that this level will hold? No, absolutely not. We can only have a probabilistic approach to the market. Only with hindsight we can be sure that these order block levels will hold. At the indicated level, a consolidation is forming. I call this a snowflake because it can take on as many formats as there are snowflake forms. In this case, two entry strategies can be used. From the break of the low, we have a high time frame long bias, and we can scan the low time frame for long entry opportunities. Second, from the break of the mitigation level, we have a high time frame short bias, and we can scan the low time frame for short entries. Let's have a look at some of these opportunities. The first is a long entry on euro-dollar on the 1 hour chart. As explained before, our bias is bullish. When price pulls back below the Asian range and touches the fib zone at the 62% level, we enter long. Our target is the previous day high. The concepts of Asian range and fib zone will be explained in more detail in further sessions. A second example is a short entry from the euro-dollar 1 hour chart. As explained before, now our high time frame bias turned bearish, and from the break of structure price action we are anticipating a pullback into the fib zone. As soon as the price reaches the 62% level, we enter short with the previous day low as target. Many more of these examples can be found on any time frame. Once you have a high time frame bias derived from a mitigation zone, you can anticipate pullbacks into a previous price action range and use previous day high or previous day low as liquidity targets. As you may have noticed, we are combining two smart money drivers: mitigation zone of order blocks for deriving the high time frame bias and liquidity theory for setting targets. Let me be clear from the start. When, if, and to what level imbalances or order blocks will get mitigated can never be known for sure. In the following example, you see a clear buy to sell candle, blue area, in a market with a bearish bias, followed by a sell side liquidity grab, creating a bearish breaker. Concept will be explained in future videos, all indicating that the order block might hold. Unfortunately, it does not. Instead, equal highs are created with buy-side liquidity on top, which is then attacked and taken out, followed by a break lower. Just for your information, see how the bearish breaker is holding on the next price impulse higher. Statistics only tell us that there is a high probability that order blocks or imbalances will get mitigated sooner or later. Therefore, we like to use mitigation more as an indicator for high time frame bias, and not or much less for entry setups. What should you remember from this video? First, mitigation is a driver of smart money, just like liquidity. We distinguished two different types of mitigation: imbalances and order blocks. 3. We prefer to use mitigation for deriving high time frame bias. If you like this video, please give it a thumbs up. If you are interested in finding out more, be sure to subscribe to our channel so that you don't miss out on any of our future videos. Thanks for watching, and in life and well-being, see you in our next video.